Good morning, everyone. Welcome to day 19 of the program. And today, which is Saturday, 27th of March, 2021, we will be starting a new journey, and the journey will be on financial instruments. And we're going to have extensive discussion from today into the immediate future on this important topic, financial instruments. Welcome once again. I am Olumiwa Adebayo, who will be discussing these topics with you in the course of this workshop, which is termed the Strategic Virtual Financial Reporting Workshop for Accounting and Finance Professionals. Now, we will be looking at this outline, or what I could call content, in the course of our discussion. And we are going to extensively discuss on this by harnessing the requirements of IAS 32, which is Financial Instruments Presentation, by also harnessing the requirement of IFRS 9, which more or less deals extensively on areas of classification, recognition, the recognition, measurement, impairment, the classification, embedded derivative, and equally edge accounting. Thereafter, we'll also look at the requirement of IFRS 13 with respect to fair value measurements, as most of the instruments will be measured at fair value. And finally, we'll look at disclosure requirements in line with IFRS 7. And at the end of the day, we'll be able to make justification as a finance professional to this discussion on financial instruments. Okay, to start, I'm going to allow you guys to make one or two contributions about your understanding or appreciation of what it is prior to now, since I'm talking to professional accountants, which are chartered accountants of many years of experience, and also what is likely going to be expectation as we begin this discussion. And the mic is open for you guys to make contribution in the next few minutes. Okay? Nuruddin, Folarin, Enaro, Babajide, the door is open. What is the expectation in the course of this discussion as regards financial instruments, and what have you more or less come across about this that you need to enhance your knowledge on? Thank you very much, Bashir.
Yeah, good morning, everybody. As in respect of financial instruments, actually is not a new topic, is what I have already familiar with. Of course, my understanding about financial instruments are the instruments that serves as financial assets on one side from an entity and financial liability on the other entity. However, I know that we have series of standards to deal with financial instruments such as IAS 32, IFRS 9, IFRS 15. Of course, my expectation as financial instruments as concerned is to know when I am to apply each of these standards in respect to the financial instruments. Of course, I know about financial instruments, but I don't have keen understanding of how to deal with financial instruments in practice. And that is the essence of this lecture, and that is my expectation in particular as a person. Thank you.
Okay, thank you very much. Okay, Who else?
Okay, good morning, everybody.
Good morning.
For me, in addition to what Mr. Bashir has said, I would particularly look forward to understanding derivatives. It's something I have always wanted to know so much about, especially the application of IFRS 9 and what the requirements are. So in financial instruments, I look forward to the practical applications or informations regarding the practicalities of using derivatives. Specifically, that is my expectation in this session.
Okay, thank you. Who else? Okay, Madam Grace. What's your expectation? What do you want to take away? What value do you want to bring to the table with respect to this discussion on financial instruments?
Yeah, good morning, everyone. My expectation is so much about this financial instruments. For the years of my experience, I've not really worked on what we know. The little ones we've been doing have just been maybe shares, valuations, all these things, and putting in audited financial statements. But with this topic, my expectation is so much that I want to be able to, even when they say auditing of banks, to be able to do something like that, and other financial institutions like insurance companies, so my expectation is so great. So, and I know that Mr. Muiwa is up to the task. So all aspects of financial instruments that you can put us through, I'm ready to learn, and that is my expectation.
Okay, thank you very much. Is Babajide there? Is Enaro there? Okay, Enaro. Enaro, we can hear you. Okay, Babajide, can you go ahead?
For me, in addition to what Nuruddin and Akinfolami have said, I think I'll be interested more in the accounting part of it.
Okay, thank you very much. Is Enaro still there? Okay, thank you for that. I think we could move ahead now. We can move ahead now on our discussion. Okay. Okay, now let me start by more or less trying to, in a small way, try to elaborate on what financial instrument is all about. Now, the first picture here, which you guys can see, let me try to put the spotlight, shows some level of spanner, screwdriver, and some other things where people talk of instruments. Now, what comes to our mind when we're growing, when you hear instruments, is much more of carpentry instruments, much more of electrical instrument tools, okay? Now, At this level, we are talking about financial tools or instruments. Okay, and what are we talking about? Okay, before we move further to break it down, I think I also want us to look at this. You could see a bull, okay? And a bull, you could see this kind of status on the New York City, where you have the New York Stock Exchange. And you also have something like this, I think in the Macadamia Tower. Is it tower on Adela Odeku? Okay, and similar stuff supposed to be seen somewhere in Marina, but because there's no space there, okay, why should it be in Marina or Broad Street? Is because that is where our financial hub lies, where stock exchange sits. Okay, and I think I'm drawing it home. And if you look at this last picture here, you could see symbols of currencies. Okay, you could see dollar, you could see pounds, you could see euro, you could see yen. Unfortunately, I'm looking for naira. I'm not seeing it here. Okay, therefore we are bringing it down home. And lastly, when you look at this picture here, you see things like 4 things trying to go out the net, go out of the window, but being barricaded by net, or is it an iron gate or iron rod or something like that. Now, but each one of them stands for one thing or the other. And one stands for equity, the other one stands for debt, the other one stands for derivatives, and the other one stands for guarantees. Okay, I think we are bringing it home. We are familiar with one or two of this. Okay, and when we now come to this word cloud, you can start to see things like stock, you see things like investors, you see things like IPO, you see things like issue, negotiate, you see things like publicly listed, and etc. Dissolution opportunity. And all of this is pointing to a direction. And what direction are we pointing to? A direction towards appreciating what a financial instrument is. Okay, what I'll try to do in order to strike a balance in better appreciation and understanding of what we are to discuss is to more or less switch between the technical and the literal way of trying to explain it, okay? And that's why I'm going through this route. Okay, I don't want to be sounding more technical, even though I'm talking to technical guys. But sometimes we can bring things home so that we can also appreciate better ways to which we can present this kind of information to those that we come across who needed our assistance towards understanding what financial instrument is all about. Okay, welcome into the section. Some of you came late, and we've just started, and we've more or less dropped some expectation. Okay, what I'll do at this point is to pause a little bit and allow Shegun to more or less tell us what you expect from this discussion and what has been your more or less your forte regarding financial instrument. What has always been your understanding about that? And likewise, Miriam just joined. Also, Miriam, put up your camera so that we can also see your beautiful face. Okay, and Naru, I think we are still waiting for you. But Shegun, I want you to start. Miriam will join. Yeah.
Okay, yeah, thank you very much. I'm sorry, I'm a little bit down with cold.
No, it's
Okay, my understanding about financial instruments, especially as it relates to IFRS 9, is that it's more or less a standard on on the recognition and measurement of financial assets such as liabilities and equity. And you know, my expectation about the program is just to take my understanding deeper, because I think I have a more or less shallow understanding of the standards, and the reason why I'm here is to learn more about it.
Okay, thank you very much. Marian, I hope you are there. I will hear your voice and likely see your face. Okay, depending when she returns. Okay, now let's continue from where we stopped. Now, I think I'm drawing it home to have better appreciation of financial instruments. Okay, but before we'll move further, let me try and reiterate something. Okay, let me share the screen. Okay, this is day 19, Saturday the 27th, March 2021. Our topic of discussion is financial instruments. Okay. Now, the first thing I've said is that we'll be making use of the following standards. Let me try and copy and paste what I've sent to you guys before. Now, this is what I've sent to you guys before. And these are all what we'll be discussing with respect to financial instruments. We'll be annexing about 4 standards. Okay. And the standards are IS1, IS 32, which is financial instruments with respect to presentation. And that's where we start from today. And we are going to break it down to understand the differences between the standards. The second one is IFRS 9, where we'll be discussing on things like classifications, recognition and derecognition of financial instruments. We'll be talking of measurement of financial instruments. We'll be talking of impairment of financial instruments, especially of financial assets. We'll be talking of reclassification. We'll be talking of embedded derivative. We'll be talking of hedge accounting. Okay. And later on, we'll look at the third standard, which is IFRS 7, where we'll be discussing of disclosure requirement. What do you need to disclose with respect to each category of financial instruments? And IFRS 13, where we'll be looking at fair value measurement, because it's critical to all of our discussions regarding financial instruments. Okay, these are what we'll be discussing in the course of our sessions on financial instruments. Okay, now let's start by this. Financial instrument is looking at 2 sides to the coin. What are the 2 sides? the investment side and the funding. What does that mean? The two sides to a coin is that financial instrument is created whenever there's a need to invest. And on the other side, there's a need for funding in order for an entity to carry on its targeted operations, which means the investment side replicates the surplus unit. Let me use grain as a surplus unit. Okay, the surplus unit is, as you all know, is the unit that has liquidity in terms of excess cash position. We want to take opportunity of putting it in something that could generate more returns. And let me use red for deficits. Units. Now, what that simply says is that we have entity B and we have entity A. Now, they need to cross and carry out exchange of actions. And this exchange of action is by way of contract. Now let's look at example. Entity B needed to expand on its production. Okay, we want to expand its production. Let me say its production capacity. Whereas it then requires funds to execute this objective, but the funds are not readily available. Therefore, it then looks up to investors. When I say investors, those that could raise such a fund. Okay, and the investors are those with surplus cash who are willing to what? Invest. Therefore, the investor is expected to fund the deficit unit with what? Cash. Now, to do so is that you are creating an investment, which means you are creating an interest in entity B. Okay, why entity B is looking up to entity A in order to invest. Now, in the course of entity B sourcing for funds from investors to expand its production capacity, entity B has the option to say, one, the investor, is it a risk bearer or a risk taker in that case, or entity that is going to invest, which is entity A, is it not ready to assume a residual risk? What does that mean? A risk bearer or a risk taker bears the residual risk. And what does that mean? That is, it's saying that if I'm to give entity B money, I'm giving entity B money in order to partake in the risk to which entity B wanted to expand its production capacity, so that where it's so successful, I gain maximum return. And when it fails, I suffer a loss. Is that what entity A want to take in B? Or is it such that entity A is not ready? Let me write it well. Or entity A is not what? Ready to assume such a risk. Not ready to assume such a risk means that entity A is saying that, no, I'm not taking up a risk. What I'm taking is that I am going to borrow you this money. It's good for both of us if the expansion goes as planned and it produces returns, and you pay me what has been agreed as my own return, which is more or less static. It's not a function of your performance. And at the end of the day, you pay me back my money. And peradventure, your expansion program fails, that still does not affect me. I'll still get what I've agreed to get. And likewise, I get my principal amount back. And in the event that you're unable to meet up, what then happens? I realize your assets because you pledge your asset against the money I've given to you, so that I can sell them off or take over them and operate them in order to recover my money. What does that signify? It then signifies that risk bearer will likely be equity holder. Why? The one that is not bearing the risk will likely to be the debt holder. And what does that signify? It signifies that then we can say financial instruments is such that is a contract would give rise to, for entity A, it gives rise to financial assets. Why for entity B, it gives rise to equity instrument, or it gives rise to financial liability. Recall, entity A is the surplus unit, and entity B is the deficit unit. The deficit unit requires funding. The surplus unit provides funding. And the process of meeting both objectives is what brings about financial instruments. Does that make sense to us? Does that make sense to us?
Yes.
Yes.
Yes, it does.
Any question? Any question? Okay. Now, what then is a financial instrument? We'll try and go back to our presentation slide. Now, financial instrument, as I said earlier, is a contract that we expect to give rise to financial asset of one entity and financial liability of another entity. Now, the next question we need to ask ourselves is this. We've talked about financial instruments in brief, but we can't have better appreciation of it until we understand what is a financial asset. Until we understand what is a financial asset, and also we understand what is a financial liability, on the other hand, and until we understand what is an equity instrument. Okay. The first thing I've said is that when we talk about financial assets, we are talking about investments. We are talking about what? Investments. And that's why sometimes you hear investment in financial assets. Okay. My pen is not functioning well today. I don't know whether it's impaired. Okay. But when we talk about financial liability, we are talking about borrowing. And when we talk about equity instrument, we are talking about issues of equity funding of an entity. Now, a financial asset begins with cash, which means every form of cash is a financial asset. The cash you have in hand, which is your paper, your coins, or the one you have in bank in any form, is considered a financial asset. Another thing that's a financial asset is the equity investment you make as an entity in another entity. And take note, the phrase in another entity is critical, which we are going to get to at a later time. Which means when you have equity investment in another entity, that is, you buy shares of other companies other than your shares, is a financial asset to you. Another thing we need to know is that peradventure you have a right, or I call it a contractual right, and such a contractual right is such that it gives you access to receive cash or another financial instrument or asset of another entity. Such is a financial instrument, and I could call that where you have things like receivables is a financial asset. Another thing you could have is that when you have a contractual right to exchange financial instrument with another entity under condition that is considered potentially favorable, that also is a financial asset. And such example is when you have debt investments in another entity. Example of such is where you have, e.g., you have bond, you own bond of another company, of the government, you own treasuries, treasury bills of governments, you own commercial papers of an entity, you have promissory notes, you have bankers' acceptances, which is BA. You have bills of exchange, which is receivable by you. You provide loans to others, or you owed a debenture interest in another company. All of this are examples of a debt investment, which is a financial asset. Furthermore, you could create a financial asset in such a way that a contract that will or may be settled in the entity's own equity interest, okay? And in such a way that is a non-derivative contract for which the entity is or may be obliged to receive a variable number of his own shares. That will create a financial instrument, and I will explain. It can also be in a situation where it's a derivative that will or may be settled other than by exchange of physical amount of cash or other financial assets for a fixed number of the equity owns shares. Now, what it means is that I'll summarize it under the heading that derivative assets are equally a financial asset, which means I summarize it as thus. Financial asset entails cash, any form of shares investment you have in another entity, receivables you have by way of trade, and debt investment you have made either by purchasing the bond of a government, of a company, investing in commercial papers of companies, investing in bankers' acceptances, which bankers use in raising funds, holding promissory notes, treasury bills, bills receivable, holding debenture, which are more or less like debt instruments with floating charge on the asset of the company, and etc. And finally, derivative what? Assets. This is much more part of what we discuss extensively, because derivatives are things that require further explanation because they are not day-to-day instruments that we are familiar with, especially in this part of the world. I'm going to explain that in detail. Therefore, these are practical things that make us to understand what financial instrument is all about. That is that. Now, financial liability. The first thing you need to consider from the angle of a financial liability is that a financial liability creates a contractual obligation. And the obligation in this sense is to deliver cash or another financial asset to another entity. And this is usually created by payables. You know, payables arose from trade. When you purchase goods or you enjoy services on credit, and you have an obligation or you have a contractual obligation to pay in cash at a later date, or if not in cash, you are bound to deliver one or two other financial assets at a later date. Secondly, it could be a contractual obligation where you'll be required to exchange financial instruments with another entity under a condition that is considered potentially unfavorable, and I will explain. A situation where you have a debt instrument of an obligation. What does that mean? Now, instead of you purchasing the bond of another company or investing in bond of another company, rather, you are the one issuing a bond in order to raise money, which means in this case, you issue bond, you are the one that issued debenture, you are the one that issued commercial papers, you are the one that issued, let me say, promissory notes. And you are the one that has a bill that is payable by way of bill of what? Exchange. And finally, you have a contract that will or may be settled in your own equity instrument, that is with your own shares, such that it is not a derivative for which the entity is or may be required to settle his own variable shares, that is his own shares in variable amounts, which is not predetermined, okay, or in such a way that is a derivative contract, okay, that will or may be settled other than in your own shares. And in that situation, what this summarizes is that we are talking about derivatives liability. The same thing happens here. Derivatives, assets and liabilities. What distinguishes them is what side of the coin or of the divide are you? Are you at the positive side where you derive a value, thereby creating an asset? Or are you on the negative side, which more or less lose values, which technically now creates a derivative liability? But again, extensive discussions will be made on derivative as we move on. Now, at this point, I'll leave the door open or the floor open for us to deliberate. What have we understood so far with the introduction to say what is a financial instrument? I'm waiting.
Thank you very much, Mr. Muiwa. I think you are taking the topic step by step. As a matter of fact, you've introduced us to what financial instrument is with a lot of hypothetical illustrations and examples. Okay, you let us understand now that financial instruments can be categorized under financial assets, financial liability, and equity instruments. Of course, you've given us the instruments that can be categorized under financial assets, including derivative assets. Likewise, you've given us examples of financial liabilities and those instruments that can fall under financial liabilities, including derivative liabilities. Now, I think we are on equity instruments, which we will expect you to let us understand what would fall under equity instruments. Thank you.
Okay, I would like to come in. Okay, yeah, this is what I've been able to pick so far, that financial instruments arises in a situation where an entity needs fund for investment in a particular project. And maybe that entity is short of fund and it has to go to another entity with surplus fund that will be willing to invest in such project. So by the time the entity in deficit meets with the entity in surplus, it creates a kind of financial liability on the side of the entity in deficit. And on the other side, the entity that has a surplus fund, it creates a kind of financial asset. On the side of the entity in deficit, it creates either financial liability or equity, something I've forgotten the other time. Yes, so equity instrument. Okay, thank you. So you also explained to us that the way we look at it is that the entity that is ready to bear all the risk, like risk bearer that wants to participate in the residual returns of the other entity. When we look at it in that way, then such a situation creates a kind of equity instrument whereby the company invests in the shares of the other entity. But when the entity that is providing fund is not ready to take up a lot of risk, then we can look at it from this borrowing point of view, especially when a bank is lending loans to organizations. So this gives rise to what is it called? Debt holders in that company. So from there, we move to the different categories of financial instruments that includes financial assets, financial liability, and equity instruments. Thank you.
Okay, thank you. Okay, Anne, you're just joining us. Marian, you're just joining us. Can you tell us your expectation so that we can move on?
Good morning, everyone.
Yeah,
So I'm just expectation. So I'm just joining. Sorry, I had like a bad network. So I'm probably just trying to catch up with where you guys started from and with what Nuruddin and Shegun have explained. I'm trying to.
Okay, I think your network is not your friend today. Okay, your network is not your friend today. We can't, it's cracking again. Okay, let's, Madam Anne, we are waiting for you.
Good morning. I'm yet to grasp, I didn't join from the beginning, so I'm still listening and try to understand what we have for today, and just try as much as I can to follow suit so that I can understand better. I will say that when you were mentioning something about the financial assets, when you were listing the cash, receivables, and something was just popping up in my head that why can't we have inventory? Who says we can't trade that an inventory can be a financial asset? I don't think I've been able to convince myself enough, even though I answered myself anyway partially that I think inventory cannot be traded, you know, as a means of financial asset. But I don't know if I'm right or it's just an illusion I'm having. So I want you to help throw more light on that, so I will understand better. So that's my view. Thank you.
Yeah, I'm really excited with your last concern about inventory. Okay, we are going to make reference to the guideline that was provided by the IASB, the National Account Standard Board on Financial Instruments, and we're going to look at it together. Why physical assets, which means I will not limit it to inventory. Every form of physical assets do not qualify as a financial instrument. And probably we'll get there and look at it, which means whether biological assets, whether inventory, whether property, plant, and equipment, or any form of such a physical asset do not qualify as a financial instrument. Okay. Thank you very much for that. Now, again, let me take us back to the PowerPoint. You can see the same thing we have discussed here. With respect to financial assets, the same thing we have discussed with respect to financial what? Liability. Now let's talk about equity instruments. Now, the first thing about equity instrument that is germane is that equity instrument evidence, any instrument that evidence residual interest in an entity assets after deducting or netting off its what? Liability. Is an equity instrument, which means the key word here is what? Residual what? Interest. Any form of instrument, which is not a physical asset, but an instrument arising from a contract that gives the holder residual what? Interest in an entity asset after the liability of such an entity has been settled off is what we call an equity what? Instrument. Now, I'll give you practical examples of it. The number one equity instrument is the ordinary shares. And we all know what ordinary shares is. Ordinary share is the share that gives you residual what? Interest in the net asset of a business. It is the shares that confine you as the sole risk bearer in the event that the liabilities of the company exceeds its assets. It's the instrument that makes you the rightful owner of the entity. But again, we have other kinds of shares, such as preference shares. And I'm going to asterisk this. Why? Because not all preference shares will virtually qualify as equity instruments. The reason being that the preference share that qualify as equity instrument must be preference share that has most of its features similar to that of ordinary shareholders. Again, another form of contract that could create equity instruments is a contract that creates deposits for shares. And I'm also going to asterisk it, but twice. What is deposit for shares? Who can tell me what deposit for shares is? Have you ever come across it, deposit for shares? I'm expecting your contribution. Deposit for shares.
Oh, thank you. I'm not too sure, but I believe I've come across deposit for shares in the financial statement of organizations. And I want to believe that this is the amount pledged into a business by potential investors or by investors that are yet to be fully converted into an equity, into ordinary shares.
Okay, why would somebody deposit money for shares when shares are not yet to be issued? Can you answer that?
No, I can't. I don't think I have an idea.
Okay, who else? Who else? The floor is open. Bashir. Yeah? Okay, try, madam.
Okay.
Madam, we're waiting for you.
Yeah.
Okay.
You can continue.
right. Like you once said, introducing while introducing the topic to us, that companies might need funds to expand their product, their business. So, to me, from my own point of understanding, that directors could bring funds, or investors could bring funds, even though the company is not yet ready to issue shares, they could bring funds to for the business of the organization. And this such funds can be treated as deposit for shares.
Okay, thank you. I think Anne wants to contribute.
Okay, I was going to answer that last question, even though Shego had said something on the first one. I think the reason why they will want to do so is basically because it's just an intention, you know. As a director that has a business now, I have the intention to grow my business further than it is now. So I bring in more capital than I had already invested. Although there's a caveat there that in the foreseeable years, the company might pay me back. But in the event that the company might not pay me back the money, so that means that particular amount can be converted to deposit for shares. So in my own opinion, I think that's what deposit for shares is for. That's an amount that is intended to be converted to shares in the foreseeable years where that company is unable to pay the directors.
Okay, who else? Who else? Okay, now deposit for shares is where potential investor or existing investor who is willing to increase the stake in the entity, more or less committed to buying the shares of the company immediately such shares are issued in the future by putting down his money in advance. Okay. Remember, no matter what it takes, issue of shares is instrumental from the application of the provisions of a company law. Whether as a private company or as a public company, you don't just issue shares without ensuring that such shares is as contained in the requirements of the company's registration documents with the relevant government authority. Like in Nigeria, we talk about CAC, Corporate Affairs Commission, which means such shares before it is issued must have been registered. Okay, and that is critical. Now, the issue then is company might not yet be ready to issue shares, but has started the process or will start the process of increasing its issue shares or its authorized shares in the immediate future. And certain potential or existing investors who are willing and eager to take a lot or a block from the issue of such shares, and which is common to privately held companies, will have provided money in advance such that when shares are issued, his own block will be guaranteed. Okay, and sometimes this arose from what Anne said, that most times when private company is partially financed by directors of the company or owners of the company, but it's not by way of shares, but probably they advance short-term finance or a long-term finance, which they've now felt that for the company's sustainability, or because of the cash flow constraints and some other things, it would be better to convert it to a permanent source of fund to the company. Therefore, what they sought to do is to more or less convert such indebtedness by the company to a deposit for shares, pending when all statutory requirements towards issue of shares will have been met. Now, the question then is, deposit for shares are not necessarily going to be considered as equity instrument at every point in time. That is why I stated it. Likewise, preference shares, and I will explain. Remember, preference shares could be redeemable and could be irredeemable. Can somebody explain the difference between a redeemable preference share and irredeemable preference share? The floor is open. Who want to contribute? Who want to contribute?
I think redeemable preference shares are the shares issued by the company with the expectation of buy it back in the nearest future. While irredeemable preference shares are the shares issued by an entity without intention of buying it back in the future. That's my little understanding.
Okay, thank you very much. Which means irredeemable preference share by their nature are preference shares that has a time to which they will be redeemed, which means where money will be paid back to the investors and the company cancel out such shares, which means it's time bound. Okay, why irredeemable are perpetual in nature, something very close to ordinary shares. Okay, which means ordinary shares are perpetual until the company decides to say, okay, I'm buying back my shares and I want to cancel it out. The same way is irredeemable preference share. And in that light, irredeemable preference share are those categories that qualify as equity. As what? Equity. Okay, why redeemable preference share qualify as a liability? Let me put it somewhere here. Preference shares redeemable. Okay.
Question, please.
Yes.
Okay, sorry, I want to ask this question if it is also a deposit for shares. In a situation where you did an investment in a company, let's say a mortgage company, and you were told that at the end of the tenure of the investments, you will be paid your interest, but you have the option of converting your investment to shares. In their book, would that be classified as a deposit for shares?
No. That's not deposit for shares. Deposit for shares means you have dropped, your money is with them. And your money is with them with the hope that in 6 months' time, in 1 year time, or thereabouts, the company will issue you shares. I'm saying now. But the one you are talking about, when we get there, we'll discuss it with respect to compound instruments.
Yeah, please, I have a question in that line too. For instance, now if I have a business and I'm investing a lot of my money into it, even though it's not registered, not talk of like filing for shares at the CAC. So the amount I've invested up to date into the business for the success of the business can it be classified as deposit for shares? Because it eventually turned to shares in that company in later time.
Yeah, the word deposit for shares is always attributable to the contract between you and the business. Remember, entity concept separates you from the business, even if you are the sole owner of the business. Now, if it's a company and you are injecting money, the question then is the intention, which must be documented. Is it that you are advancing money by way of borrowing to the business, or you're advancing money in support of the business such that such money in the immediate future will be converted to a permanent source of capital? The answer to that question will tell us vividly whether it is deposit for shares that qualify as equity or the deposit for shares that qualify as a financial liability, or is a pure financial liability, which is form of lending money to your business. Okay, now the conclusion we want to say about deposit for shares is that what is critical, which I've not mentioned since, is that there is a thin line. There is what? A thin line between a financial liability and an equity instrument. And what is in that thin line is the question. The question is to distinguish between a financial liability and an equity instrument. The answer to the underlying question will be of great importance. And what is it? The question is, is settlement required? Is settlement what? Required. At any point in time, to distinguish, especially for those things that are not obvious. Things that are not obvious are like deposit for shares and preference shares. Ordinary share is obvious. Bond is obvious. Debenture is obvious. But what is not obvious to us is deposit for shares and preference shares. And these are examples of what we call a hybrid instrument. A what? A hybrid instrument. What is a hybrid instrument? A hybrid instrument is an instrument or a financial instrument that has both the features of equity and the features of a financial liability, which means the features of equity instrument is embedded alongside with the features of financial liability. And we call such an instrument a hybrid instrument. Now, for such is somehow dicey or somehow tricky or difficult, anyone you decide to choose, in determining where do they fall? Do they fall as a financial liability, or do they fall as an equity instrument? Now the question is this: if your answer here is yes, that is, settlement is required. Now, regardless of the manner to which settlement is required, is secondary. Regardless of that manner, once settlement is required, at every point in time, it is a financial liability. Which means you must understand the substance, not necessarily the legal form of the contract between the person funding and the person being funded, between the surplus unit and the deficit unit. But secondary is now issue of, okay, how will the settlement be made? That one secondary has nothing to do with whether it's a liability or it's an equity. But once you can tell me that, yes, settlement will be required, therefore, I need not bother in most cases about how, what medium, what mode, okay? But if the answer is capital no, therefore, it is an equity instrument. I believe it's clear. But for industry knowledge, I'll take it further to say, okay, if settlement is required, in what form? Do we get it right? Now, in what form can settlement be made? Settlement might come by way of saying that, okay, as at the time we enter into this contract, we have agreed a specific date, whether it is 10 years, is 3 years, is 6 months, is 5 years, that settlement will be paid. It could also take a form that is interest part of the settlement, whether yes or no. Once settlement is involved, whether interest or principal or both, is still a financial liability. Because there are some instruments which create a financial liability but does not require interest being paid on a periodic basis. Some might be a discount instrument where I borrow 1 million from you for 3 years and I just pay you 1.2 million back in 2 years' time. I'm not paying periodic interest. Some, the settlements vary in such a way that they might tell you that, okay, this money I've collected is redeemable. Let me say a bond. It's redeemable between 2022 and 2025, which means it could be done either in 2022, whether in 2023 or latest 2025. Regardless of those structuring, for different reasons, which are more or less business in nature, settlement is still required. And in that situation, we consider it a financial liability. Which then means if you relate this with deposit for shares, if in the contract for deposit of shares, the condition is such that for every period my money is still with the company and they have not issued me shares, I will earn interest on the money. Therefore, for no reason, it's going to be considered as a financial liability. Do you get my statement here? If I deposit for shares and I am interested in being equity participant, therefore I should not be getting interest, because interest is like a compensation for holding on to your fund. Secondly, even if I don't get interest, and the condition in the contract is that when I deposit and shares are not issued within a given period of time, my money will be paid to me with or without interest, which means I have the right to call back for my money. Therefore, it's not an equity instrument, because settlement, in one way or the other, is required. But if not, do you get what I'm saying now? Deposit for shares, which is common to privately owned businesses, will qualify as an equity instrument. The same thing for preference shares. A redeemable preference share either can be redeemable in the instance of the entity that sourced for that funding, or at the instance of the holder. Regardless of what it is redeemable. It's a matter of time. Therefore, settlement is required. It's a financial liability. Otherwise, if it's a perpetual preference share such that it is not redeemable, except at the instance of the company, similar to the way a company can buy back its own shares, therefore, it is an equity instrument. Does that clarify it now? Now, I'll give you some questions. From all what we have discussed so far, identify out of the underlisted, which one or more is a financial instrument? A, biological assets. B, trade payables. C, current tax payable. Trade receivables. Accruals. Prepayments, or what you call prepaid expenses. Accruals, or what we call accrued what? Expenses. Inventories. Intangible assets. Investment properties. Deferred tax assets, or deferred tax and deferred tax liability. What else can I give you? Swaps. Options. What again can I give you? Callable bonds. Payable bonds. So what else can I give you? Okay, I think this is enough for now. Now, I'll divide you into groups and you discuss this extensively for 5 minutes and you come out with your own listing of what constitutes of all of this, which one or more qualify as. And you must know the justification for why they qualify and why they do not qualify. Okay. Let me how do I do it now? Okay. Let me try and save this first and share it with you guys. So that I can download it and you download it on the chat room. And I can also send it to your WhatsApp. Okay, you can download it now. I've sent it to that. Let me also send it to your WhatsApp and send it to your chat room. Okay, I hope you have downloaded it. It's on your WhatsApp and your chat room. I'm creating you guys to your breakout session now. The room is open now. Kindly join. Okay, we are welcome back. Group 1, where are you? Who's representing you?
I am.
Yeah.
Okay, let me read the question again for group 1. Identify out of the underlisted which one or more is a financial instrument. You can proceed.
Okay. Good afternoon. On behalf of the group 1, I'll be representing them. And we met and we came to a conclusion, and they are as follows. For biological assets, it's not a financial instrument. Reason because it's a physical asset. Trade payable is not also, is a no, because they are not, is a physical asset and is not contractual in nature. Then current tax liability is a no, because is an expected tax to be paid on the
an obligation
on the profit. Yes. Then trade receivables is not a financial instrument. Accruals is not a financial instrument. Prepayment is not a financial instrument. Inventories is not. Intangible asset is not. Investment properties is not. Deferred tax assets and deferred tax liability is not. Reason because they are not contractual in nature. Then for swap, it is a financial instrument. Options, yes. Callable bond, yes. Putable bond, yes. And the reason we gave is that they are contractual in nature. So we have some that are under financial liability, and also we were able to identify that one of them is also an equity instrument. So that is our conclusion from group 1. Thank you.
Okay, thank you. Group 2, who is representing you?
Sir.
Okay, ma'am.
Group 2.
Yes.
We agree that it's not a financial instrument because it's physical. Trade payable, we agree that it's a financial instrument because it has an undertone of contract. And the current tax payable is not a financial instrument payable item. Then trade receivable is a financial instrument. Accrual, we agree that it's a financial instrument. Prepayment, we agree that it's a financial instrument as well. Inventory, we agree that it's not a financial instrument. Intangible assets, investment, deferred tax assets, and deferred tax liability, we agree they are not financial instruments. Swap, we agree that the financial instrument, the derivative, so also options. Callable and putable bonds, they are financial instruments. Thank you, sir.
Okay, thank you. Now, where you guys have issues which is not aligning with yourself, which have not decided whether you are even right in others, but where you guys have issues are this, and I think this. Okay, let's start with that. Trade payable. What is trade payable? Trade payable evidences that there is an obligation by an entity to deliver cash or any other financial assets to another entity, given that the other entity has either provided a service or has sold an item of goods to it. And therefore, the transaction itself that gives rise to trade payable is not a financial instrument. But the result of such a transaction has created a financial instrument. And if you go back, you understand, I make examples here to tell us that trade payable or payables, I use the word payables, which might be trade or any other form of payables, are what? An example of financial liability. Therefore, invariably, Group 2 got it right that trade payable is a financial what? Instrument. Likewise, trade receivable. Now, E and F, accrued expenses. What is an accrued expenses? An accrued expenses is more or less where you incur a cost. You have enjoyed a service, usually utilities, and of which you have not been invoiced. Example is if you use postpaid meters for your electricity. As at the end of the month, you have not been invoiced and probably might take another 20 days or more, depending on the efficiency. But you have to close your books and you have to do what? You have to accrue for the expenses you have enjoyed for completeness of account. Therefore, what do? You debit your expense line and you credit a liability. Rather than credit a payable, you credit an accrued expenses account. And the essence is that an accrued expenses, though, is a liability, but the liability to which an invoice has not been raised, okay, and it's not yet payable. And therefore, at that point, it has not created a contract to which you are expected to part away with cash. And at that point in time, such is not a financial instrument, which means group 1 got it right. Prepayment. As you all know, prepayment is that the only way you can get value for it is by enjoying that service. It's not by receiving cash, okay? For example, if you are preparing rent for 3 years, after 1 year, can you walk up to your landlord and say, okay, I'm going, give me back my money? The question is, the landlord is not bound to give you your money. You are prepared for a service, and that service has been provided. It's now for you to elect to either use it or not. Do you get what I'm saying now? And at that point in time, a prepayment as an asset does not qualify as a financial asset. Neither does it qualify as any form of financial instrument. And in that case, group 1 also got it right. Okay, which means when we look at it, I've not said other ones you got them right. But when we look at it, group 1 and group 2, you had a tie. Okay, you had a tie. And okay, whether it's encouraging or not, I can't say for now. Let's look at other ones. Biological assets is a physical asset. Inventory is a physical asset. Investment property is a physical asset. And we have said earlier that physical assets, in line with the guideline 8 of the ISB, when it comes to financial instruments under IS 32, basis of conclusion and guidelines, you find out that physical assets, okay, control of this creates an opportunity to generate an inflow of cash or probably other asset, but it does not give rise to a present right to receive cash or any other financial assets. Because, for example, physical asset, when you have your inventory, which right do you have to receive cash from anybody? Who even says anybody will buy that stock from you? Talk less of you saying you have a right that somebody must pay you cash for that inventory. Inventory means goods that is in your hand that is yet to be sold. Therefore, such does not. Likewise, biological asset or investment property. Okay, intangible asset as it is does not, because intangible asset is a form of non-physical substance asset that you have created or you have acquired, of which is expected to draw up economic benefits. That is provided such benefit is inherent and is available in the immediate future. Current tax payable, as I have said, the word payable there should have created a financial instrument. But because the payable is not created by way of contract, therefore it does not give rise. The question then is, you have no contract with government to pay taxes. It is sacrosanct that you pay. That's why I do tell people, and as I've discussed under IAS 12, when we discuss income taxes, that the nature of tax is that you don't even question government, except for responsible government that even want citizens to question, to say, I'm not going to pay my taxes because government has not provided this. It's not. Do you get it now? Your commitment to fulfilling your civic responsibility regarding taxes is not on the basis that government is fulfilling its own responsibility. Do you get it now? And therefore, by nature, payment of taxes is not by way of contract that you can negotiate. It's by way of compulsion. And therefore, this is not a financial instrument. And likewise, deferred tax asset and deferred tax liability. They are not a financial instrument, not because they are taxes alone, but because they do not give rise necessarily to outflow of cash. They are just mere accounting measure. If you remember from our discussion of IAS 12, they are just mere accounting measure in order to ensure that we fill in the gap that has been created by complying by the law regarding taxes, but we need to recognize the substance of the transaction over the legal form, and we need to account for that variance, which is by way of creating such an estimate of value towards recognition of deferred tax assets and liabilities. And finally, I intentionally smuggle some of these things in for one and two reasons. The first reason is to expose us to derivative contracts, which we are going to discuss extensively. I could hear the two groups at the background. Some people are going online to search and everything. It seems this is the first time some are hearing swap, or they have been hearing it, but they don't really bother about what is it all about. I could hear people talking about literal meaning of swap, callable, call means call, bring it back and all sorts of things. Therefore, I could hear all those things at the background. And that is also to trigger the next level of learning. The second thing there is also for you to be wary of what goes on within the dynamics of the business environment, where people are now creating various kind of instruments, sensitized instruments, structured instruments towards creating value. Okay, even though we've started to talk about cryptocurrency and blockchain, okay, is also an instrument, but not necessarily a financial instrument. The conclusion as of today is that it's more of an intangible asset, which we are going to discuss. But again, it has started to gravitate into an asset class. But again, we'll discuss that as we move on in the whole course of this program. Okay, any questions so far, or any contribution or any side remark based on what we have done so far?
Excuse me, sir. I understand the explanation to all the listed items, but I would just appreciate if someone in the audience can throw more light on accruals for me and why it doesn't qualify as a financial asset.
Okay, it's open. And in addition to that, I want to add two things again. These two things I want to add. I want you guys to assist me here. There are two things I want to add. This O and P. I want to add provision. And I want to add, what should I add again? Okay, let me add deferred revenue or deferred income or unearned income. Provisions such as warranty, etc. Okay, the same person can also contribute to that between accrued expenses, provision for warranty costs, and deferred revenue. Who is that? Who is going for it?
Hello?
Yes.
Yeah, from the explanation, accrued expenses are expenses which has been incurred but has not been invoiced. So as a result, there is no obligation as such when you are enjoying that services. He gave an example with NEPA postpaid meters. So you must have enjoyed it, but there is no a commitment or of payment of cash. You just need to do it for accounting purposes. For the fact that you have enjoyed the service, you just need to completeness of accounting, as Comrade has said. And from all the points, from the justification I've seen for all the items listed as a financial instrument, it has always been related with cash flows. That's the comment I wanted to make, that cash flow has been a critical point of determining whether an item is a financial instrument. I don't know if I'm correct. That's one. Two, on provisions and warranty. I want to say, based on the fact that there is still won't be okay. Warranty is like a. I don't think there's going to be a cash flow. There's no cash flow. There's not going to be a cash flow movement in provisions or warranty. That's just from all explanation from what I've been getting. Deferred revenue definitely is going to be a revenue that's on hand income that you have. There's going to be a cash flow movement within that in the later future, as we have recognized it now as revenue, but in the future there will be exchange of cash. So that qualifies as a financial instrument. Thank you.
Okay, let me start with, okay, first, I'm confused. Jide, your name is now showing as Miriam. How come?
No, I'm joining, my laptop is down. So I'm joining with my phone. So she sent me the link one time like that.
Okay. Because so I'm shocked now that because you started, but now you talk to Miriam.
We are okay.
Doing you know what happened is that you have restricted her from joining because they control. If we call her now, she's unable to join. It's better you use your own link to join. My laptop is down, comrade. Will you send me a link? Okay, wait, let me search and send you a link, because if you call her now, she'll tell you she's unable to log in because you are using her ID. Seriously? This is synonymous to ID theft. Okay. Because I was shocked when you're talking and I was seeing Mary and I said, oh, what's going on here? Okay, wait, I'm trying to get your link. I'll send it to you now. Okay, because that's the control we've put in place, that is only one person that can join, and it must be a registered person. If you give another person your link, you will be restricted or barred from joining. Okay, that's the world of technology, which means you don't need to have any gatekeeper or anything. Technology is doing that for you. Have you all seen the technology that was invented in Nigeria? I think I shared the video at the time, where in practice now, you don't need to spray money. They have a barcode or QR code that they will display. It's just for you to scan it and you transfer. It's so magnificent, and it's so nice. But imagine you wrongly send barcode and the whole of your balance in your account disappear. What happens? How do you settle the matter?
You're on your own.
Problem.
The matter is what we are saying.
But it takes away the fun of spraying money now. Since we are used to spraying money, dancing, once you have sent your money, you can go and
you know what you have to do in life now is that you must more or less, change is constant. Therefore, you must embrace change. You can't continue to do things the same way at every point in time. You understand? Look at the classes we're having now. 2 years ago, if someone tell you to do this, you say, no, it can't. Physical class, it can't be like. But today, physical class cannot meet up the efficiency of this kind of classes in any manner. In this class now, we are going to go to video session, go to this session, go to Excel session, go to this section. Do you get what I'm saying now? Which you cannot do in a physical class, even when you use PowerPoint presentation or when you use a projector. Okay? Why did they? I've tried to copy your stuff now. Okay. And I'm sending it to your WhatsApp so that please call Maria and apologize that you have deprived her of and that's the problem, why she have to share her ID with you. Okay, I've sent it to your WhatsApp. Okay, thank you, sir. Yeah. You can log out for her now so that she can log in. Ensure you call her on phone because she will have been frustrated at the other end. Okay, I think we can continue. Now, Babajide has explained critically the accrued expense. If we check all our definition of financial asset, financial liability, and etc., we make mention and emphasis about cash or any other financial assets. Anything that does not give rise to cash, whether to receive or to pay, or any other financial asset will not by any way be considered a financial instrument. And that should answer Shegun's concern why accrued expenses is not a financial instrument. Provision is not a financial instrument, the same way as accrued expenses, even though three things make up a liability: payable, provisions, and accrued expenses. Okay, but two of them, provision is just trying to make an allowance for the likelihood of a loss or an obligation that will come across as a result of uncertain amount or timing. Okay, even within payable is where we have current tax payable, which is still not a financial instrument because the nature of current tax payable is such that it does not come as a result of a contract. And deferred revenue, though my brother Babajide said deferred revenue is a financial instrument, the answer is no. Deferred revenue is not a financial instrument. And the reason being that we need to first of all understand what is the definition of deferred revenue. Who can explain what deferred revenue is before I now proceed on justifying why it is not? Welcome back, Miriam. Miriam, can I hear you? Why will you share your ID with somebody else? We can't hear you.
I wasn't sharing. I was trying to log in with my phone.
But you give me Babajide your login one time in the past. He was one using your ID because he was talking and I'm seeing Miriam. I have to tell him to exit and give him back his own login because his laptop is off. You see? You can't log in. You can't log in as Miriam. Two Miriam can log in.
That's funny.
Okay, Babajide, have you apologized to her for identity theft?
Comrade, they will settle that, don't worry.
She was not aware. We are both not aware.
You didn't follow the rules that was said that you don't share your ID. Okay, no problem. Welcome back. Sorry for that. Okay, but why did you said deferred revenue is a financial instrument, and I said no. But in order to answer it appropriately, I want somebody here to briefly explain what a deferred revenue is. What is a deferred revenue?
Let me try. A deferred revenue sounds like an expected revenue in a future time, whereby maybe the source or the transactions that will give rise to such revenue cannot be determined today. I'm just trying to use the opposite of deferred.
Okay. Who else? What's the deferred revenue?
Okay. It's a okay.
You can go ahead.
It's revenue earned, but which is going to be recognized later in the future.
No, how can it be revenue earned and you are recognized later in the future? Revenue earned means you have recognized it. That's what it means. What's the deferred revenue? Check.
My understanding is that it is a revenue that will be recognized in the future, maybe because the performance of the obligation has not been been done. For instance, maybe there's a contract that allows you to earn maybe 200 million, but in this present accounting period, you've only done 50% of that contract. And to such extent, you can recognize only 50% of the revenue, whether or not the cash has been paid. But the other 50%, which we have to carry out later in the subsequent financial year, you can recognize it as on-hand or deferred revenue.
Okay, deferred revenue is a liability, I guess. I said deferred revenue is a liability, I guess. Am I correct?
Yes.
No. Okay, okay.
It is.
Okay. Now, Anne, over to you, and I'll conclude my statement after your.
It can be
Deferred revenue is, in my own opinion, money we have received money, but we are yet to recognize that revenue in that period. So that's the way I see it. So as a result of that, is a liability. Okay. Because tomorrow, sir.
No, I said okay. I'm hearing you.
So as a result of that, because I've collected the money from the customer has paid me, but I'm yet to carry out that obligation. So I can't recognize that revenue for that period. So I have to defer it. So in the course of deferring, it's a liability because the customer can also come back tomorrow, or that contract can collapse tomorrow. So that's why I see it. Number one, it is money we have collected, but yet to carry out that obligation. Then two, it is a liability.
Okay, thank you very much. Now, until you are unable to deliver the service and you have to return the money, okay, that is when it becomes payable, which means deferred revenue is a liability but not a payable. Do you agree?
It is a liability, but it's not a payable.
Yes, I agree.
Okay, can you tell us why you agree?
Yeah, I'm agreeing because it's a liability, but it's not a payable because if you eventually satisfy the agreement, then you don't have to pay back the money to the person that gave you in the first place. So it's more likely that the company will satisfy the agreement or fulfill the contract, then it will not give rise to a payable.
Now, remember that we drew up a tripartite relationship that says a liability has three sides to it: payable, provision, and accrual. When we say accrual, we mean accrued expenses. All of these are liabilities, Abi. Now, Shagun, if you say that payable, if you say deferred revenue is a liability but not payable, which form of liability is this if we only have these three kinds of liabilities in our books?
So I think it should be a payable.
No, you said it's not a payable.
Honestly, I'm confused.
Okay, who can define, even though I've defined it today, who can define?
I'm sorry, sir. I'm also confused why it's even a liability.
Okay, let me put it to you so that I can understand better. Let me explain deferred revenue from the angle of purchase of goods or sale of goods. You are a seller of an item, cement. I want to buy 100 bags, but you have 40 bags. But because I'm wary of it, I needed it urgently. I paid you for 100 bags, but you deliver immediately to me 40 bags. And I pay you the 100 bags because so that if your new stock comes in, before you start to sell to anybody, you reserve my 60 and deliver it to me first. I paid you, let us assume for simplicity's sake, a bag of cement is 1,000 naira. I paid you 1 million naira for 100 bags. No, that's 100,000 naira for 100 bags. You have delivered 40 bags to me. And 40 bags is 40,000 naira, okay? But I paid you 100,000. First, how do you recognize the entry and why? What entry will you recognize and why?
First, I should recognize assets by debiting cash for 100,000.
Yes.
Then the 40,000, the 40,000 stock that I have made, that will be sales, which is revenue.
Yeah, revenue. That's 40,000.
Yeah. Then I'm left with 60.
Yes.
So, okay. So because the 60 is, okay, the 60 sounds like a liability to me, okay.
Why is it a liability? Because you have an obligation to deliver.
It's an obligation,
60.
Yes.
Now, be careful about it. It's an obligation not to deliver cashew, but an obligation to deliver 60 bags of cement.
Yeah.
Obligation can be to deliver cash, can be to deliver other financial assets, or can be to deliver physical assets or services, which is cement in this case. The reason why it's not payable is that there's no obligation to deliver cash, therefore it's not payable. But it's an obligation to deliver bag of cement. Okay, now if it's an obligation to deliver bag of cement and it's not payable, what is it? Is it an accrued expense or is it a provision?
It is a provision.
Okay, before we answer that, Madam, what is a provision in line with IS 37? Just break it down to us. Let us know whether it's a provision. Madam Anne, we are waiting for you. You are thinking, Madam Anne. Okay, who are sister?
I was okay.
Yeah, continue.
I was wondering why you called me.
Okay, because you said it's a provision. And I'm asking you, what is a provision?
Is an estimation that will set aside for a future obligation.
Okay, yeah, you are practically right. A provision is a liability of uncertain amount or timing. What does this mean? It is a provision because we don't know the time we'll be able to fulfill that delivery, and if we can, it then means we'll be bound to refund the money. Between now and when we are given the deadline to deliver the bags of cement, is a provision in form of a deferred revenue. But when we fail to meet up and we are now bound to return the money, it becomes a payable, which means it's no longer deferred revenue. It is now classified into a payable, which means where cash is required to be delivered, no longer delivering the bags of cement. Does that make sense now? Which speaks to the fact that deferred revenue is not a financial instrument. Do you enjoy it at all?
Right.
Okay,
Yeah.
Thank you, sir.
now let's go back to our PowerPoint. We've discussed equity instrument also. And in summary, this summarizes our examples of financial assets, financial liabilities, and equity instruments. Okay. Now, the next level is derivative. Is what? Derivative. What I'll do for you at this point is that I'll first of all play a video for you. And after playing that video, I'll come down to break it down further in order to have extensive discussion on this. And I want us to have an open mind because derivative is much interesting amidst other financial instruments. Okay, let me try and play the video.
Hello and welcome. Today we'll be providing a brief introduction to financial derivatives. This video is intended only to provide a general picture of what derivatives are. The four most common types of derivatives will be examined in greater detail in standalone videos in the coming weeks. So what exactly is a financial derivative? Well, in its most general sense, a derivative is a contract whose value is based on something else. But more specifically, the term financial derivative refers to any security whose value is determined by or derived from the value of another asset. The asset from which a derivative gets its value is known as the underlying asset, or simply underlying. An underlying asset can take many forms, but it commonly refers to stocks, bonds, commodities, currencies, interest rates, and market indexes. The most important thing to take away from our discussion of derivatives so far is that their value depends upon the value of something else, the underlying asset. So, the change in the value of a derivative's underlying causes a change in the value of the derivative itself. This is all well and good, but what's the point of derivatives? Well, there are two main uses for derivatives. The first is to hedge risk. Derivative hedging generally refers to the practice of using derivatives for the objective of minimizing risk in the physical market. In order to demonstrate how a derivative can be used to hedge risk, consider the example of wheat producers and cereal manufacturers hedging their exposure to fluctuations in wheat prices. As we know, wheat is susceptible to significant fluctuations in price, owing to both supply and demand. A fall in the price of wheat is bad for wheat producers because they can get less money for their crops. but is good for cereal manufacturers because they can get one of their key inputs at a discount. On the other hand, an increase in the price of wheat is good for wheat producers because they can get more money for their crops, but is bad for cereal manufacturers because it increases costs. So, it is in the interest of wheat farmers that the price of wheat remains high, but it is in the interest of cereal manufacturers that the price of wheat remains low. Now, if a wheat producer expects that the price of wheat is about to fall, and a cereal manufacturer is of the opinion that the price of wheat is about to rise, the two parties can enter into a contract fixing the future price at which the wheat will be sold. For example, a wheat producer might agree to sell wheat to a manufacturer in 6 months at the current market price of $12, regardless of what the market price for wheat is in 6 months. By locking in the price of wheat, the producer is seeking to protect his or herself against an expected decrease in the price of wheat. On the other hand, the manufacturer is seeking to protect his or herself from an expected increase in the price of wheat. If the price of wheat falls, the cereal manufacturer or buyer will wish that they hadn't signed the contract, because they could be buying wheat for cheaper had they not signed it. Conversely, if the price of wheat rises, the producer or seller will wish that they hadn't signed the contract, because they could be selling wheat for more money had they not agreed to the contract's terms. Because the price of wheat can only move in two directions, up or down, this example is a zero-sum game, possessing both a distinct winner and a distinct loser. Basically, the interests of only the wheat producer or the cereal manufacturer can be met, not both. So, in this example, a forward contract was used by both wheat sellers and wheat buyers in an effort to hedge price risk by locking in the price of wheat. We will discuss forward contracts in greater detail in another video, but what is most important to take away from this example is that derivatives can be used to hedge risk. The second main use of derivatives is speculation. Derivative speculation is fundamentally different from derivative hedging. Where derivative hedgers are trying to reduce their risk exposure and usually are not motivated by profit in the derivative market itself, derivative speculators are motivated purely by profit seeking. Basically, hedgers seek to limit risk by using derivatives as insurance policies, while speculators are directly driven by the opportunity for profit. Now that we have a basic understanding of how derivatives are used, let's take a look at the different types. There are four main types of derivatives: forwards, futures, options, and swaps. Each of these concepts will be addressed in greater depth in future videos. Here, our aim is only to provide a basic overview. With this in mind, let's begin with forward contracts. A forward is a customized contract between two parties to buy or sell an asset at a specified price at a specified future date. Forwards are not traded on a central exchange, and as a result, they are not standardized or regulated, making them particularly useful for hedging. Futures contracts are fundamentally similar to forwards. However, unlike forwards, they are standardized and regulated so that they may be traded on a futures exchange. Futures are often used to speculate on commodities. An options contract is a contract that gives the right, but not the obligation, to buy, call, or sell, put, a security or other financial asset. Finally, a swap is fairly self-explanatory and refers to the exchange of one security for another based on different factors. So we have seen that derivatives are contracts whose value is based on something else. We have seen that they can be used for either hedging or speculating, and we have briefly touched on the four main types. This brings our overview of financial derivatives to a close, but please stay tuned for our videos.
If this is $100 billion, then this is how much you'd have to pay to buy Apple today. This is the amount of all the gold in the world, this is the GDP of the entire world, and this is the notional value of all financial derivatives. They've become the biggest asset class in the world, so you should probably have a rough understanding of what they are, how they function, why on earth there are so much of them, and why Warren Buffett called them financial weapons of mass destruction in his 2002 shareholder letter and warned that
derivatives could accentuate in a major way a systemic problem that might even arise from some other phenomenon.
While at the same time, he also really likes to use them.
What's his history with derivatives?
Well, he has a checkered history with derivatives.
We have 200, I know every single derivative we own.
You don't know anything about derivatives? Good news, I'll tell you. Sit back, relax, grab some popcorn and listen. The word derivative comes from the word derive, which comes from the Latin word derivare, which actually comes from the ancient Egyptian word for nobody cares. In the case of financial derivatives, this simply means that you create a piece of paper which derives its value from a so-called underlying asset. Company shares, a house, crude oil, your student debt, no kidding, pretty much anything can be used as the basis for a financial derivative. Even, wait for it, another derivative. A derivative is just a contract between two parties betting on the change in price of that underlying asset. And as the price of that asset changes, the price of this piece of paper, our derivative, changes too in some different way. The relationship of this price change to that price change is what derivatives are all about. It is the reason they are bought and sold every day in such massive amounts, for good reasons of prudent financial management and for crazy reasons of insane speculation. However, they are based on an innocent idea. Imagine your friend has a bike, a shiny bike, that he wants to sell for $500 in 3 months, because he'll be moving to Hyrule. You tell him, listen, I promise you that I will buy this bike from you in 3 months for $500 if you promise me that you will sell it to me and only me then and nobody else. Your friend agrees to that deal and you write it in paper. Sign here and here. Congratulations, you created a derivative. A contract between two parties which derives its value from an underlying asset. Okay, I hear you say, but what do you mean this piece of paper derives its value from whatever you said? Say 2 months have passed and it's still 1 month before your friend leaves. And the company that makes those bikes just hiked their prices. Now your friend could easily get $600 for his bike if he sold it to someone else. Except he can't because he already has a contract with you which obliges him to sell it to you and only you for $500 in 1 month. Feeling a bit smug, you go to the interested buyers and tell them, I will sell you my side of this contract for $100. Then you will have the obligation to buy my friend's bike in 1 month for $500. Someone agrees and takes your place. Effectively, this guy is now getting this bike for the total amount of $600 he's willing to pay, while your friend is still selling his bike in 1 month for the $500 he wanted. And you are making a $100 win on your derivative 2 months after signing it. This type of derivative is called a forward contract, or in short, forward, and is one of the 4 main types of derivatives. All of them are contracts between a buyer and a seller, in fancy finance lingo, also called the long side and short side, and they are all zero-sum games, meaning whatever one side wins, the other side loses. How has your friend lost $100, you ask? Well, he had to sell something that's now worth $600 for just $500. In general, when two parties enter a forward contract, they agree to trade a certain underlying asset at a predetermined date called maturity for a predetermined price called the strike. And because people love trading forward contracts, some greedy bastards, thanks, had the idea to, instead of having to write out a whole contract every time, just copy and paste a few general ones that might be interesting to anyone. Like 100 Tesla shares on 15th of December for $800 per share. Such standardized forward contracts are called futures contracts, or in short, futures. They are just sitting on the shelf waiting to be adopted by a buyer and a seller. Every day, traders buy and sell millions of futures on company stocks, oil, gold, and you knew it, your student debt. And as the price of the underlying assets change, so do the profits and losses of each side of the contracts. Both parties can exit their side of the contract any time before maturity, locking in their profit or loss in that moment. And whoever holds the contract at maturity needs to settle, meaning one side needs to pay and the other side needs to deliver the underlying asset. No joke, WTI crude oil, for example, has a delivery point in Cushing, Oklahoma, where millions of barrels of oil change ownership every week. Did you notice how forwards and futures give both sides of the contract an obligation? This trade is happening at maturity no matter what. One party must sell on date for price, the other party must buy. Enter options contracts, also called, you guessed it, options. They too are a contract between two parties to trade an underlying asset at a predetermined date for a predetermined price. Here's the catch. Options have one extra burn it button attached, which at maturity, one side gets to press if they want, freeing them of their obligation to buy or to sell. If your friend had signed an options contract with you at the end of the 3 months, he could have had second thoughts, pressed the button, and sold his bike for more. Now, I hear you yelling, "That's not fair!" You signed a deal. Here's the catch for your friend. The burn it button has its price, and you shan't sign sans reimbursement. Because special treatment requires special payment, your friend pays you $10 to sign, the cost of consent. Come maturity, if your friend wants to sell today, you will have to buy this bike for $500, consummating the contract. Rewind the clock, he doesn't want to sell for whatever reason, and presses the burn it button, causing this piece of paper to perish, leaving him his cherished possession and you with a $10 profit. You just signed a so-called put option, which is one of the two types of options. It gives this guy the right but not the obligation to sell an underlying asset at a future date for a predetermined price. Put it on the market, so to say. To get this right, he must pay you some money today, also called a premium. This is a list of actual put option contracts being traded on Amazon stock right now, each featuring a maturity date and a premium. Pay this money today and you will have the right, but not the obligation, to sell Amazon stock at this date for that price. Receive this money today and you will be obliged to maybe buy Amazon stock on this date for that price if the seller so wants. That's the deal. You might wonder, who decides how high these premiums are? Why does it make sense to pay exactly that amount of dollars for this particular put option? That's getting us deep into the pricing of derivatives, which is a really big topic for another time. The simple and true answer is, the market decides, just like the stock prices themselves. The reverse of a put option is a, you guessed it, call option. In our scenario, it literally looks like this. It gives you the right, but not the obligation, to buy the underlying asset at a future date for a predetermined price. To get this right, you must pay your friend some money today. This covers the main types of derivatives. If you're confused, rewind and rewatch. Those concepts take some time to internalize. Why in the world do we need those contracts? Wasn't banking just fine without them for thousands of years? Short answer, no. Long answer, no. The reason you originally signed this forward contract with your friend is that you really wanted his bike. Securing an underlying asset in the future for today's price is one use case for financial derivatives. A common example of this is fuel hedging. Airlines spend a lot of money on fuel, not as I'm making this video anyway, but usually. Companies really like to plan their costs, and since oil prices are an absolute roller coaster, knowing where they will be in a year is tricky. Hence a company will prefer to just lock in a price today for fuel they need in the future. And guess how they can do that? Just buying enough fuel for a year would solve that problem, but you don't want to spend a gazillion dollars of your precious cash for fuel that you need a year from now. Also, do they really want to sit on a nuclear weapon worth of explosives? No. Therefore, airlines enter long-term futures all the time. They fix a price today for in 6 months when they usually do not take delivery of the underlying, but sell the contracts last minute for profit or loss and enter new ones for the coming period, and repeat. This is called rolling over your futures. If the oil prices rise, they make a profit on their derivatives, which makes up for the increased fuel costs during the same period. If the oil prices fall, the reverse happens, stabilizing costs despite an unpredictable oil price. This reasonable use of derivatives is generalized under the term cost hedging because you get it. But maybe you weren't really interested in getting the bike anyway, you just had a hunch that these bikes would go up in price, in which case you used your derivative for speculation. When you buy a stock and it goes up, you make some money. But for that same investment, you could have bought, say, 100 call options or entered even more futures. It's called leverage. It means that a small move in the market translates into a big move in your portfolio, and a big move translates into a crazy one. But it's a knife that cuts both ways. If you are on the wrong side of history, your options expire worthless, causing you to press the burn it button, losing your initial investment. And if you used futures, you don't even have that option. Of course, you also could have used derivatives to bet on the decline of the asset. For example, by selling call options. You collect a premium, doubling your money, which you get to keep if the price closes below strike at maturity. Or by buying put options, in which case you make a $1 profit for each dollar decline. But that's all good old hindsight bias. When you need to make that decision, you don't know which way the stock is headed. And that's true for oil, crops, avocados, your student debt, all become bettable using derivatives, and you better know what you are doing. And that brings us back to Buffett. The reason he called derivatives financial weapons of mass destruction isn't because they are inherently destructive. You can use nuclear energy to electrify a city or blow it up. Speculators make derivatives destructive when they risk money they don't have to make a profit they don't need. And that's just dumb. With new tech allowing everyone to trade derivatives more easily than ever, we need to be careful to not accidentally blow something up.
Okay. I think we are back. Any contribution? Okay, I'll give us 5 minutes for break and we'll return back in 5 minutes time. By 1:05, we expect to return. Okay, let's look at derivative as we have said it earlier. And let me start by sharing these notes. When we talk about derivative, the first thing we need to know is that one is a financial instrument. And take notes, not all derivatives are financial instruments. And I'll give you the quality of what makes it a financial instrument. That's why in simplest form, we say financial derivatives are financial instruments. Because we have financial derivatives and we have commodity derivatives. The whole derivative discussion we are having now are financial derivatives. Okay, which means I qualify it in front. I say financial derivatives, not commodity derivatives. Now, financial derivative is a financial instrument with the underlisted attributes. The first attribute of it is that it has little or no initial investments. That is, if you have a derivative contract where you enter into without even putting 1 naira down, or you enter into it for a value of 1 million and you are just putting 2 naira down. Therefore, you are putting 2 naira or 20 naira or 200 naira for an investment of 1 million naira. Therefore, in that regard, we say this is one of the key qualities of it, and we are going to explain it. Second thing about it is that it has no value of its own. Rather, it derives its value from the value of underlying. Okay, what are the examples of the underlying? You can derive it from market factors, such as market factors, also known as market variables, such as prices of commodities or items, interest rates, inflation, foreign exchange rates, etc. And this underlying are most considered as assets in most cases. But the nature of it is that the derivative can be written on anything that has value of its own. Derivative can be written on what? Anything that has value of its own. Okay? And it can also be written on another derivative, including financial assets. Okay, that is a key factor. On its own, it's nothing. But when it depends on other things that has value, it's something. Thirdly, it requires only future settlements. That means it's something that is to be delivered or settled in the future, not today. Anything you do today is a spot transaction. Anything you do in the future, which has been agreed today, is a derivative transaction. And fourthly, it must be net settled. It must be net settled in cash. When you add this scenario, we say we have a financial derivative, which is a financial instrument. I will belabor us further about the essence of derivative. It has been summarized for us that one, primarily it was created as hedge instruments, which means it's to hedge volatilities in prices of items in which you do business in or you trade. But today, derivatives have grown by the involvement of speculators who are there to profit on it. And one thing is that derivative, even though it creates bubbles that may burst, but the speculators have equally created liquidity within the market and has made that market more efficient for even hedgers to make use of. Because without speculator, you can't effectively have an hedging position. You that you want to throw away your risk, you want to transfer your risk to somebody else. If there's nobody on the other side that is ready to gamble that that risk will not crystallize, therefore let me take it, there won't be opportunity for you that want to transfer risk to transfer. The same way, if there's no insurance company that is speculating that, okay, this thing will not happen, or if it happens, the severity will be low. You that you want to get insurance won't be able to buy insurance. And that is the beauty of it, which means it's about the good and the bad, the ugly, and the beautiful within the marketplace. Okay, that is that. Any question before we move further? Now, furthermore, I want to break something down for us. Derivative can be viewed from two forms. Which means there are two forms of derivative contracts. The first form is forward commitment. The second one is contingent claim. I'll explain. The distinguishing factor between this is that in every contract, there are two parties. Party A and party what? B. The uniqueness of forward commitment is that both party A and party B have obligations, contractual obligations that must be fulfilled in the delivery of this contract. Whereas for a contingent claim, you have party A and party B. where party A has rights, but party B has what? Obligations. And in this case, we call it a contingent claim. Now, let me break it down. A full commitment is seen as symmetric or symmetrical. A contingent claim is seen as asymmetrical, or what we call asymmetrical, depending on whether you are using Queen's English or you are using American English in terms of pronunciation. The word symmetrical means both sides of the divide are equal and balanced. The word asymmetrical or asymmetrical means one side has more weight than the other side. But what is that all about? We'll discuss that. But before discussing, I'll break it down that forward commitments comprises of the following contracts. 1, forward contract, which is otherwise known as forwards. 2, futures contract, otherwise known as what? Futures. And 3, swaps contract, otherwise known as what? Swaps. Now, for a contingent claim, the only contract there is the options contracts, otherwise known as what? Options. Now, let me now create the uniqueness of those contracts. Forwards, futures, swaps, and options. What are their uniqueness, or what distinguishes one from the other? 1, a forward contract is a customized contract. That is a customized derivative contract. What does that mean? It means that it is an over the counter, or what we call OTC contracts. I will explain. The nature of it is that it requires no initial deposits or investments. It requires an exchange of a single cash flow in the future. And lastly, it has a credit watch or default risk. These are the attributes of forward. The word customized contract means that it's a contract that can be done by you and I without anybody telling us what to do, similar to the video we watched. Which means tomorrow you are expecting dollar from your uncle in 3 months' time, and you want to take it to pay your school fees in 3 months' time, which you change to Naira. In 3 months' time, I need dollar to pay my own school fees abroad. I have the phobia that Naira will have depreciated further, which means I'll be looking for more Naira to buy the same amount of dollar. You are thinking that, the way Nigeria is going, government is bringing some innovative ideas and dollar can crash against Naira, which means Naira works stronger than dollar. And therefore, when you collect your dollar money from your uncle, by the time you change it to Naira, you'll be getting lower value. Therefore, two of us come together to say, okay, this is the price we are going to exchange. That is what we mean by customized contracts between two willing parties without any intermediary or a standard exchange coming in between them. And which is also what signifies over-the-counter contract. No initial deposit means that it's just exchange of paper. We sign contract, paper, and we'll go. But that paper is a contractual document that is admissible in case of any issue between two of us, because it's what will evidence the kind of contractual agreement that exists between both of us. Second thing is that, or the next thing is that it requires only exchange of one cash flow. In 3 months' time, you give me the $100, I give you the Naira, and we move on. Okay, single cash flow. It's not attached to future periods again. That is the only, anytime you collect money from your uncle again, I have no business with it. But the one we have business with is the one that we have agreed for the next 3 months. And there's a default risk or credit risk involved. What does that mean? You need to take note of the fact that if tomorrow you collect the $100, but because Naira is now trading at 600 Naira, and two of us has agreed that we exchange at 500 Naira, therefore you can simply come with a story and say, your uncle did not send the money again. Therefore, sorry. Or Naira comes to 400 Naira, and I've agreed to buy it from you 500. I say, sorry, the school fees, I'm no longer going to that school. Therefore, sorry, I'm not buying again. You can say now. Therefore, at that time, there's a default. And a default creates a loss to the person that is gaining or winning. And that is attribute of a forward contract. Now, to counter some of these negative attributes of a forward contract is why we have futures. Futures is the same thing as forward contract, except for the fact that one, is a standardized contract. Standardized contract means it's not a contract between two parties. It's a contract that is facilitated by an exchange, such like the stock exchange, which is an organized market, not over-the-counter market, which means it trades or is executed in an organized market, such like the exchanges, such as the exchanges, such as Chicago Merchant Exchange and any other exchange you have. Similar to that exchange we have in Nigeria is commodity exchange in Abuja, and that is for commodity derivative, which is not that effective or efficient as a market, but it's not for financial derivative. Okay. Thirdly, it requires initial deposit. Little in that context, initial deposits. And the deposits is in form of a margin as required by the exchange. Why do you do this? It's because here we said there's default risk or credit risk here. But to avert this credit risk, you allow every participant to have deposited such that that will have covered for any loss that such a credit risk will have created. In other way, it has no credit or default risk because the risk has been assumed by the exchange, and the exchange has mitigated against the risk because of the initial margin required from you as a participant. But one thing that's also common between them is that it requires an exchange of a single cash flows. That is that for futures. Now, swap has all of the features of forward contracts, okay? Which means swap by its nature is a customized contract. By its nature, it is traded or executed in an OTC market. Third, it requires no initial deposits or investments to enter into it. Now, the critical thing of it is that rather than exchanging a single cash flow, it exchanges series of cash flows. And I will explain that. And one thing that it shares exactly as forward is that it has a lot of credit or default risk. In summary, it is an off-the-run forward contracts, and I'll explain. All this you can read more about forward contracts. Futures and swaps. That is a customized contract, is very straightforward between two willing parties. And every customized contract is traded outside the normal trade, which is outside the organized trade or exchange. It's traded over the counter. It requires no initial deposit, it's just exchange of paper, signing commitments. That's why we talk about forward commitments. Now, what makes it unique from a forward contract is that, unlike forward contract that you just want to exchange one cash flow, this one you want to exchange at least two or more cash flows. How? I'm offering MBA abroad. And the beauty of MBA abroad is that your tuition fee is not paid at once. Most times, your tuition fee is spread on a quarterly basis. Let me assume I'm doing MBA for 12 months, and they can allow me to pay for 4 quarters, 4 payments in 4 quarters. Let me say my MBA is $40,000. They allow me to pay $10,000 each quarter, starting from January, April, July, and final one in October. Now, I have a friend that the parent pays allowances. The parents are abroad. He's in Nigeria, schooling in Nigeria. The parents pay his upkeep from abroad every quarter in advance. He's always receiving $10,000 every quarter. And you have to change it to Naira to pay for school fees, pay for accommodation, feeding, transport, and etc. Now, what happens is that because I'm aware of that, I now agree with him to say, I will be buying $10,000 from you from January on a quarterly basis for the next 4 quarters, which ends in October, at the rate of 480 Naira. Now, both of us agreed that in the next 4 quarters, we'll exchange at that rate. Such a transaction is what we call swaps. The first example we did was a forward because it's only one cash flow we agreed. But this one, we agreed more than one exchange of cash flows. This is even 4 cash flows that we are going to exchange within a year into the future. Such a contract is what we call what? Swaps. Swap is a collection or a series of forward contracts, which means having more than one forward contract with the same person under the same terms and conditions. Okay, options. Option is a black sheep out of them all, because option, from our consideration earlier, is that option is a contingent claim. Okay, why is it a contingent claim? We started with the fact that it's asymmetric. Asymmetric in the sense that one of the party has a right, while the other party has obligation. Rather, in other contracts, such as forward, swaps, and futures, both parties have obligations. Now, in this case, what is the uniqueness of option? An option is a customized contract. Like forward and swaps. An option is traded or executed over the counter. Option, it requires an initial investment, though not necessarily significant to the contractual value. Four is that an option usually requires exchange of a cash flow, but its customization, such as a swaption, may require series of cash flows. That is an extreme situation. The word swaption means you write an option on swap, That's what we call swaption, which means option and swap together. Okay. Next is that it has a credit or default risk. Okay. And take note, it is an asymmetric contract, asymmetric derivative contracts with it is an asymmetric derivative contract with a party having with a party obtaining a right and the other party has an obligation. That is the uniqueness of an option as a contract.
I have a question, sir.
Now, any question now?
Okay, thank you. Yeah, my question is, in a scenario whereby the two contracting parties put in the agreement that if the fluctuation in maybe exchange rates or interest rates or whatever is beyond a certain limit, then the contract should be like
terminated.
For instance, now maybe we've agreed that we are going to exchange our dollars for 450 naira. But if it goes beyond 5% or 10%, I mean, if it's beyond or below, I mean, if it has a kind of 10% or 5% difference, then we will not go ahead with the arrangement. So it has to qualify as a derivative instrument.
Now, the question is, you will not go along with the arrangement. What does that mean? It means that, are you going to still settle yourself based on the upper limit or lower limit that happened, or that the contract now becomes a nullity?
Yes.
And therefore, that is just I'll call it a firm commitment, not necessarily a derivative contract. It's just like a firm commitment, like a promise. And at the end of the two of you as friends, you just say, well, this thing has gone beyond necessary, and let us, that's not necessarily a derivative, because it's more or less like you guys are not ready to do such a contract. You are just dilly-dallying in the real sense. Derivative contract is a factual contract, it's a contract. And I don't think what you have mentioned earlier is even a contract in the first place. It's just a mere promise between two parties that are friends, that you can always walk away with one another. Yeah, thank you for lying.
So I want to try to tweak the Shegun's analogy a bit. Let's say for that period, okay, since you said you don't think it's a contract, okay, I want to ask that, let's say for that period, for the period whereby the dollar in this scenario is still within 5%, is there any accounting for such a contract? let's say by the end of that, the future dates we are looking at, the dollar eventually went up, which we have agreed that we will terminate. But for that moment that the dollar is still within range, can we say we have a contract?
That in its real sense, if at the inception of the contract, these stories of and when you go beyond this, and everything will cancel and everything is on the table, I don't see it as a derivative contract. Because there's nothing factual in, in what you have done. It's like two of you don't even know what to do. You don't know the position. You understand? Everybody's just trying to put up one thing or the other, and later you say, okay, we're not doing it again. You understand? I don't think that would qualify. Okay. Because there won't be a basis to ascertaining anything. Because
like it's not a contract itself.
Yeah, we are looking at uncertainties within the market, and you are trying to hedge against your risk, and somebody else is ready to take opportunity. Therefore, if the essence of what brings about derivative itself is not what you share philosophy of, therefore, I don't think that should eventually be considered a derivative. Does that make sense? Now, let me shock you that everything we have discussed so far is still within the framework of IAS 32, financial instrument presentation. And we have just barely gotten to like half of the discussion. But this half of discussion is more fundamental than anything because that is what introduces us to understanding what first make up financial instruments before we now start to deal with the implication of we entering into a contract regarding financial instruments vis-a-vis the accounting impact or implications that this portends to us. Any other question? As we wrap up the class soonest in preparation for our discussion in the next class. Yeah.
Sorry, yes, I want to know the reason why you call options the cash cow.
A cash what?
Cash cow.
I never call option a cash cow.
Okay, maybe it's misconception.
No, I said it requires series of cash flows.
Okay.
There's no cash cow anywhere.
I think it's because you called it black sheep or something.
Oh, black sheep.
I said it's a black sheep because it is one standing against the others. See it here now. 3 are on one side, is only on the other side. That's what it means by black sheep. It's just a narrative, nothing attached to option that is black sheep. It's like in a you are in a class and 3 people come from the same country. You went for foreign training. There are 4 people in the class. 3 of you are from Nigeria. 1 person is from another country. That person is like on his own first before you start to build relationship.
Okay.
Yeah.
Okay. I have a kind of contribution to this, sir.
Okay.
Yeah, we spoke about futures that there must be a sort of organized market for it. Yes. And secondly, there's a kind of little initial deposit.
Yes.
And the essence of this is to is to bring reliability into the contract.
And protect parties to the contract, especially all the parties to the contract, the party that is gaining or winning, and to ensure that there's no default.
To ensure that there's no default. So is there any way we can bring blockchain technology into this, like to improve the reliability?
Okay, probably that might be a discussion for the immediate future. You understand? Okay, blockchain is just a technology to decentralize the ledger. Okay, and it's more or less to facilitate exchange. But derivative is not about exchange. It's about transfer of risk or taking opportunity where risk exists. Because anywhere there's risk, there's return. But the question is, are you willing to bear the risk? You can say that. And that's my own honest view at this point. Okay, any other question?
Yeah. To clarify my doubts, for forward contracts, I want to believe that all the items that has the features of what we call underlying variables, which you stated are like, I mean that can get its value from underlying variables like foreign exchange,
Commodity
market
prices,
price,
prices,
all those things.
FX
It
rate,
shows that
interest
every
rate.
item qualified to be used under forward contracts, right?
Yes, forward contract is customized. You can use anything. You can write forward on anything. Okay. Likewise, other contracts. Okay, but future contracts by its own nature is standardized, which then means that within that exchange, if certain underlining are not acceptable in that market, you can write the features on it. Okay, because the creation of features is by the market itself. That is the exchange, or what we call the clearing house. Another name we use for an exchange in futures contract is a clearing house. Okay. Okay, any other question? So that in absence of no question, tomorrow's class will start 2 o'clock on the dot, and it will be the continuation of technology in accounting. You continue with technology in accounting, where you'll be discussing in continuation on Python, blockchain, cryptocurrency, and the likes. Thank you very much, and God bless you.
Thank you very much, Comrade. God bless you too.